Morning, Chris.
What's up, brother? Nice to see you.
Good to see you. This is Brian Jones. I'm here with Chris Hood, professional trader, world's most interesting man, chilling out.
Whenever you say that, I feel so bad because my wife calls me the most boring dude in the suburbs. So I don't know, man. Interesting to who? I don't know.
Yeah, I mean, well, people that want to learn options, you've done a lot of cool stuff in your life, though. You've done a lot of travel, done a lot of martial arts. He's got a lot of.
It's called the third world, man. That's what happens when you come out of the womb. It's like you fend for yourself.
So you've been basically traveling and moving around since how old were you when you started?
First time I left my home country, I was 18. When I was growing up, we had sanctions applied to us in South Africa because of the apartheid government, right? So we couldn't really travel as freely as we would have liked. So for most of my life, I lived under the National Party government that used to control the media, and they used to control everything. And I remember back in the 80s how the rand was stronger than the US dollar because of all the gold reserves that were in the country, right? So, I think it was $1.83 at some point to one rand. I mean, it was amazing. But it was a very different kind of upbringing. You live a completely sheltered existence. You were basically told what to believe and told what to think by a group of Lutheran, Afrikaners that, I don't know. I think that the transformation of South Africa, it's disappointing to look at it now from the outside. I mean, I've been away now 10 years, and to see the level of corruption and incompetence and, all of that, it's sort of like, it's just another country now in Africa, and that's disappointing because the people deserve a lot better. But, here I am in socialist paradise up north in Canada, nothing like waiting for your COVID vaccine. I mean, you put your name down and, oh man, I don't know when I'm going to get it. I have to try and time it so that I'm not trading with COVID.
Yeah, you don't want to do that.
I had surgery a couple of months ago, and I remember going to the dentist. I had to have a tooth done, and they gave me these really wicked painkillers.
Yeah.
I think I saw you that day, and I came in and I was trading, and I was gone, man. I was on these pills, and I did some of the best trades I've done in my life. And I got in the next morning, and I look at my P&L, and I go, this is amazing. I'm going to try and do it without the pills today.
Mm-hmm.
And I did it without the pills, and I lost everything that I'd made the day before. So I had to try and keep one pill, just, it's like one of those limitless pills, take it when you need it.
So if I'm understanding you correctly, you need to be high in order to trade properly.
Well,
the more opiates you can pop, the better.
Well, the thing is, when you've got clarity of your mind, and I guess that this is an interesting thing, because when you've got clarity of your rules and your mind is completely focused, trading, you get into the sweet spot. Mm-hmm. And your timing is amazing. It's like jiu-jitsu. It's like, you know that thing where you get into a role and it's just, you're flowing, man, and you can feel what the guy's doing before he does it. And before you know it, 10 minutes have passed, and it just like, it goes in the blink of an eye. In trading, you can get to the same sort of Zen-like spot.
It's like the zone they talk about. In the zone.
This is why I'm a big believer in the control process. It's like you have to have this set of rules. And the more you do the rules, the more it becomes like muscle memory, right? So the more you shrimp, the easier it gets. And the more you practice your takedowns, the easier it gets. Your body gets accustomed to it. So with trading, it's the same thing. The more you get accustomed to the same process over and over and over again, your ability to spot those needles in a haystack improves dramatically, because you can feel when it's coming. You can feel when the market is not moving the way that it should, or it's not operating the way that it should. If you understand the connection between, volume of, buyers and sellers to movements in the index, and it just takes practice, you can get a feel for it. And once you've got that feel for it, your trading sort of, gets into it. You can enhance this a little bit by taking, doctor prescribed medication.
Right.
There are ways to do it, but it was quite an interesting experience seeing my account go up, and then I tried the same thing without the painkillers. I was like, bye profits, So
Well, I've heard a lot of people talk about, say like getting high, like with THC and grappling, and how it like, reduces the chatter and increases your focus.
yeah, you have
I
to.
mean,
I think in trading you've got to do it. There's a lot of moving parts, and your lizard brain takes over. It's unbelievable watching new people go into the trading world, and seeing how their emotions are so primal, their fear factor, their greed factor, and how it all plays out. And if you don't learn to control it early in your career, I suffered from it. I mean, like, I'm not talking just out of a book here. This is what happened to me. You read all the books, you follow all the emails, you do exactly what they say, and you win on one. And you go, this is amazing. I'm not going to worry. I'm not going to, just do 1% the next time. I'm going to do 5. And then you load up and you might win again. Market rewards bad behavior. Remember that. And then you win again. And you go, I am a flippin' genius. And then you put 7% on, bang, and you lose everything you've just made on those last 2 trades. And this is it. Your confidence then goes from a high to a complete low. Now you got to rebuild from behind zero. And most people's trading journeys are like that. It's this profit, loss of everything, back to zero. Now we get back to zero. Confidence is booming. We win again twice, and then we go back down under zero. And by the end of the year, they look at it and they go, all this work, stress, effort, their hair's gone gray. They've got the big gray beard. They look like they've aged 40 years. They look at their numbers and they go, all of that work for nothing. For nothing. There was no gain for them. And this is the sad part about what I've just got this email that I've opened up here. It says, this guy's number one rule in trading is don't buy options. Options buyers lose money 7 out of 10 trades. That's bizarre. I have an 80% win rate on long options, so I don't know what stats he's using. So either he's buying the wrong one, or he's only surveying the people who lose. And this is the ironic thing about it, right?
Where did you get the quote from?
Wrong, of course you're going to lose.
Yeah.
He's not telling you that they did it wrong. He's just saying they lose money. So this advertising, I almost feel like we're getting to this point where we've reached the pinnacle of everything. We reached the pinnacle of Bitcoin when Coinbase was listed, and then Bitcoin fell from there on out. We've reached the top. This irrational exuberance has come back. The Greenspan was right. If you go back way before you were born, there was a guy called Alan Greenspan once upon a time.
Yeah,
he talked about the irrational exuberance in the tech market back in the 80s and 90s, all right? Or back in the 90s or early 2000s. And I think we're almost at the same point. We're at an inflection point where we've got, these faux experts telling people, honestly, and I mean this with all, with all honesty here, there is so much garbage that if you followed these guys, you would see that it's garbage, but yet people fall for it because there's always this selling point of a hack and an easy way to do things. You can do this while you're shopping and you trade on your phone. The amount of people that I know that have lost money from trading on a phone as opposed to sitting in a focused environment with their computer and doing a plan. Oh my God, it's just ridiculous. So, if someone is designed or they are aiming to find the simple, easy road, be prepared, because that easy road is just going to take money out of your pocket and stick it into someone else's. This road is an incredibly hard journey. And no one on the internet's telling you that. They're all saying it's easy. You just have to read this 5-page PDF and pay me, $500,000 a year or whatever it is, and I'll make you rich. But they don't, there's that one guy, Raging Bull, I think it was, where the guy went to jail.
Yeah.
Yeah.
There was some sort of fraud. I'm not really sure what the charges were, but I
think there was this thing about he was charging people and then not refunding them or something like that. And I look at that and I go, every single advertisement that I've watched of people that sell these, trading courses or whatever, all of them have got these massive setups, 5 screens, graphs all over the place. They look like it's so professional. And I look at this and I go, you don't need that. Like you don't need that. I trade off one computer with 2 laptops and that's it. And I'm still making money. I don't need that setup. And it's quite intimidating, but it's also quite falsely advertising to people what you need to be successful. What you need to be successful is a bit of gray matter in your ears. Like between this space needs to be, it can't be vacant real estate. There needs to be something in there and a plan. And if you build the plan and
You don't need like massive computer screens on every wall.
Oh yeah, like 10, 10 all over the place. And I look at this and I go to my wife and I go, do you think that would make me better or not? Could you imagine if you're a trader with ADHD?
And it's like me going to I'm not a huge sports fan. So when I go to a sports bar and there's like 11 televisions all playing different
you can't
games,
watch one.
I can't stand it. It's I can't do that.
I have these 3 computers. I have my ledger on the one side. I have my trading computer here. So when I do a position, I put it into my ledger, I move on, and I have my algos running on another system. Done. Don't need 25 screens. I don't need to pretend that I have a private jet. I don't need to rent out a private jet and pretend it's mine. And I think that this is important. It's really important for people to realize that there's a layer of bad advertising or perception, whatever you want to call it. If that's what you think is going to happen to you with your $10,000 account, you're sadly mistaken. And this requires work. It requires effort. And, you can simplify this over time. I mean, I've managed to reduce my workload significantly through coding and working with developers and, trying to find ways to, create these waiting screens so that when I see an opportunity, all the hard work is already done. It just pops up on the screen and says, do the trade or doesn't do the trade, right? Because I know what setups work. If you go into one of these, sort of academies where they sell you a, $25,000 course. I mean, I know of a course down the road where a guy sells a 2-day advanced trading course for $20,000. And I'm like, what are you going to learn in 2 days that you're going to be implementing that's costing you $20,000? The amount of, you have to either be incredibly rich or incredibly stupid or both in order to fall for that, because you're not going to be able to make that money back, at least in the first year, unless you're willing to take exorbitant risk that they're probably not teaching you about. So there's a lot of this out there. And I really just hope that anyone who's watching this, just be conscious that this is designed to take money from your pocket and put it into theirs. They have no vested interest in whether you make money or not. It's to sell you a convincing story and make you believe you can do it. I know from experience, having been, in that as a, enthusiastic consumer of all sorts of things that come out, going, well, I did what you said and it didn't work. And I did what you said now and it still hasn't worked. So I really encourage people, learn to build a plan. And that to learn how to build a plan is not a complicated, it's not a complex process. It's paper trade, test. Does the result work? Yes, carry on doing it. If it doesn't work, don't do it. It shouldn't be a matter of, this guy's trades are really good, I'm just going to follow him, because one day he's going to give you a shitty trade and it's going to fail. And then you lose and then you go, damn it, what did I do? Your plan has to be around sizing. What are you going to do when the trade does this? What are you going to do when the trade does that? Preset, so that when that happens, your lizard brain doesn't take over and go, oh, panic. What do I do now? You've written it down. It hits there, you're out. Everything in this game is about statistics and allowing yourself the space for your statistics to play out. So if your win rate in your 30 days of paper trading is 80%, you know that you need to, have volume in order for that 80% to play out, right? You can't get an 80% win rate on a 2-trade strategy. It's not going to work because you don't know the distribution of your win rate. So you might lose 10 in a row and that might blow out your account. And then all of a sudden you ran out of money and you were just about to hit a winning streak of 20 trades. Do you see what happens?
People lack an understanding in general of what probability means. Yeah. And probabilities over time, about how an 80% win rate can mean you could lose 20 in a row on 80%.
Absolutely.
Yeah, because it's in each trial is independent of the other trial.
And imagine if your plan had no controls around sizing. So the 20 that you lost had been sized at what, at 5%? You've just lost your whole account. It's gone. There's no coming back from that unless you want to go sit on the road with a cardboard sign. Like, this is the reality of trading. So if your rule should be, for strategy A, I can't risk more than 0.5% of my account, and I'm going to do 10 of these at a time, knowing that my win rate is 70%, I know the most I can lose is 1.5% of my account. I know that because it's 3 times 0.5%. So position sizing solves 95% of people's consistency problem. 95% of your consistency problem. The other 5% is your lizard brain kicking in at the wrong time, getting greedy and so on. So building a plan, being conscious about how the thing, what's your end goal? When I take on new clients, I always say to them, what is your goal? What's the purpose of you doing this? And if someone says, I just want to make money, I really tell them to go back and reflect on that first, because making money is easy. Making money is really, really easy. Okay, finding a good trade is not hard to do. What's hard is being consistent at it, because you're not going to have every trade as a winning trade. So making money is not that hard. Being consistent is very difficult. So some people's results tend to go up and then they crash, and then they go up and then they crash. And this is what a plan will eliminate, is this volatility of your return. What you're looking for is this consistency. Oh, there's a really nice trade, the Google trade that we did a couple of weeks ago. Here's a nice trade. Let's leverage into that trade. Let's make as much as we can. So we take the setup and we add more, we make more. Then we carry on with our normal day jobs, and then we find another trade like we're doing now at the moment with Amazon. We get in, we build our position. We've now got 5 or 6 trades that are sitting there on the Amazon trade. We let that one play out. We find the next one, whatever it might be. But you've got to remember that the most important thing is going to be this consistent return over the period of the year. And when we have these home run shots, we nail it. And, most people don't care about the singles. They just want to be the guy that hits home runs. And it's the fact that those home runs are infrequently distributed along your trading plan. That's the problem, right? I don't know which trade will develop or, move into being a top trade. I don't know. So what I do is every trade that I do is evenly matched at the beginning. So they all get this little allocation. And the next day I will check it. And if the trade is starting to move in the right direction, so the timing is moving, the price is going up, we're starting to see a profit developing, I will add another position to it. Whether it's the same position, another contract, or further out, or whatever it might be, another strategy. I might add a bull put spread to a call spread, start funding the position, but building this position up. And then the next day I check it, it's moving again, add a little bit more. So you gradually build the position as the position earns that capital. It must earn that reward. I might do 10 positions on a day, and 6 of them take a little bit longer to deliver, but 3 of them are starting to move out of the gate really quickly. We don't put the money into the slow ones. We put the money into the big ones. And sometimes those slow ones, they look like they're going to go and then they just fizzle out. Okay, I accept that, because that's part of that loss ratio. That's part of the losing portfolio. There will always be a losing portfolio. Let that die a slow death. It doesn't really matter. If I'm losing 0.5% on that account or on that trade, but I'm making double on a triple-sized position. So I lost 0.5%, but I invested 1.5% in this, and I'm making a double on that. I'm more than compensating myself for the loss that I've taken on those trades that don't work. And that's the schematic of it. Now, how I do it: long call spread, bear put spread, bull put spread, butterfly, unbalanced fly, condor, whatever it is. That's a totally different conversation. Totally different conversation. What you do and when and how that connects to your indicators, totally different conversation. A lot of people don't teach that. What they teach is, here's the naked put. Go off and do it. Where the naked put fits in, what type of setup you should be doing, how much it should be weighted, can you add to it, can you not add to it, what are the risks of it, what are the benefits to it, what are the profit targets, all of those things. No, they don't teach that. They just say, here's the naked put, great idea, it pays you $5,000. But they don't realize that when you get high yielding transactions, there's a reason for it. There's high risk there, but they don't teach that. That's where it all falls over. So someone gets greedy, dollar signs in their eyes, and they go, oh, I'm going to put in a lot of money because this guy over here said it was a great trade, so I'm going to do it. Bang. That's where they lose. And that, you've seen it. You took ownership of some shares you shouldn't have taken.
Yeah, I'm dealing with some allocation issues, right? Or like assignment issues. Sorry.
So this is where the plan becomes really, really important, because if you've got your plan right, all of those other pieces will slot in, and you'll be able to tell when it goes wrong, what you did wrong. Because a lot of times I get people coming to me and going, oh, the market turned against me. No, it didn't. Market doesn't turn against anyone. Market is what it is. It doesn't even know you exist. It doesn't care what you think, and it doesn't really care, what position you have. So the market can't turn against you. What happened was you got greedy and put positions on that were inappropriate based on the condition that you failed to interpret. So if you're not interpreting it right, don't blame the market, blame yourself. As a trader, that accountability is really important. I have it with a lot of clients. They'll phone in and, market turned against me on this position. No, market didn't turn against you. And if your plan is such that you just add whenever you want to add and you don't know why you're adding, then what happens is when the position turns against you and you go in and say the market, you're not learning from that experience. You're going to repeat the same thing again. You're going to build into a position, market turns against you. How many times I've read people's trading plans where they've written on the side reasons for loss, market turned against me. And I'll call them back and I'll go, what are you saying? And they go, oh, but the market, no, the market never turns against anyone. The market is what it is. It's a collection of random people doing random things. It's you failed to interpret what the randomness was. So if the indicators are, if the SPY is sitting at the third Keltner channel and you decide to overload with a 9% position going long and the stock pulls back, is that the market's fault or is that your fault?
People don't like to take ownership of failure. I mean, they like to externalize their failures and then take credit for their wins.
How many people advertising on Facebook talk about how bad they are? No. How many of them sell the story about their loss rates? They never talk about it. If I was to believe everything that I read on or hear on these adverts, these guys have never lost $1 in their entire life. And I can tell you now, I've lost a ton. I've lost a ton trying to follow what some of these guys have done before, right? This is going back 20 years. The problem is you could be doing everything you believe to be right. Everything you'd believe to be right. You could be reading all the books. You could be following all the courses, everything, but it's always someone else's thing. It's not yours. And as soon as you get it wrong, it's not your fault because you followed what he said. It's this guy's fault. He should never have written that in the book.
It's easy to point the blame and not take responsibility.
Absolutely. If there's one thing trading will teach you, it's personal accountability. And I believe that 100%. When I look at my P&L at the end of the month, I cannot blame anyone for it. I cannot blame anyone for it. If I miss my number, it's my fault entirely. Okay, I don't miss my numbers very much, but I take credit for when I've done well, and I take accountability when I don't do well. And when I don't do well, I have to understand what I did wrong. So each trade that I've messed up on, or if I've lost any money on it, even if it's part of the 30% that I'm guaranteed to lose, all right, I need to understand what it was. Was it a poor setup? Was it my timing? Did I overpay? Did I overpay and then miss an opportunity to average down? Or did I just go for the wrong setup? Was I just trying to add volume when I should have been looking at quality? And this is a good point. In this season, now that we're going into summer, we become far more conscious on the quality of our setups as we did compared to November to May, right? So November to May, it's almost like you're fishing in a lake and you know exactly where the fish is. So if you know that the fish are in this little area and you sit in your boat, and I'm not a fisherman, so forgive me if this metaphor is completely off. But if you know where the fish are and you're fishing and you're hitting fish, that's fantastic. But you could have another guy sitting 25 meters from you fishing and not hitting anything. But we're in the same lake doing the same thing, but one guy's successful and another guy isn't.
So what is generally speaking, how does the summer affect trading?
It's mainly liquidity. So you have a lot of people taking holidays, right? So you've got a lot of the traders and the big guys in Wall Street will go away, right? So people start to reduce their book size. They start to, take time off. So a lot of it is liquidity driven. You've also got seasons for all of your sectors, right? So there's certain sectors that do better at certain times of the year. And if you're interested in finding out more about that, pick up a copy of this really, really great little book, Stock Market Almanac. They have a lot of information in here around seasonality. There's stuff on stock charts as well where you can see how stocks perform. It just happens to be the cycle of life, really. You can't be trading you can't be always at the top end of things. And we've done this before where we look at certain things moving through this rotational graph, right? The theory around relative rotation. So you have things moving from improving to weakening to lagging to leading. You've got this sector, right? The sort of rotation. And everything goes through that cycle because that's how money flows. It flows to weaker stocks that then start to perform. We take profits from the performing, we move them back into the weaker, we go back into the performing, because nothing stays on a straight line. Nothing stays on a straight line. So everything goes through that cycle. And then when it comes to summer, what I've found looking back at my notes over the last couple of years, what I've found is that it's not hard to make money. Don't get me wrong. It's not hard to make money. It's just different. So what got us money between November and May, using the Christmas rally, January, all of that stuff, February is always a bad month. We knew I've been talking about that since November, watch out for Feb, and the guys didn't listen to me. They left their books on and they lost a lot, right? So when you look at the strategies that would work well in an upward rising, strongly trending market, so your directional bias is to the upside, you can use things like long call options. You can use things like bull call spreads. They tend to have higher win rates in strongly trending markets, right? And bull put spreads as well. They work really well in those environments. Markets accumulating, there's a lot of acceleration behind stocks. So we trade that trend. But as soon as things start to dip a little bit, things become a little bit more choppy. You can see this by reductions in the ADX indicators on stocks. As soon as it starts to drop below 25, that trend loses a little bit of momentum. So things aren't moving up as fast as they used to be because now they've got exhausted. And you can use the squeeze indicator to determine exhaustion as well. When it starts to change color in either side of the positive or negative of on the histogram, it means exhaustion is happening. So if they've been light blue going up and now it's dark blue, we know that the upward momentum is getting exhausted. It's tired. And that usually coincides with a third Keltner move. At that point, you want to be selling a call spread on a long call, creating a debit spread, protecting yourself to the downside. You want to start looking to take profits at that point. And then it's the same thing on the reverse. When you see the red turning into yellow, it's exhausted to the downside. Things are going to start improving. It's the same cycle that you have throughout the year. So one of the things that I like to look at is weekly squeeze, because the weekly squeeze doesn't fire a lot. It fires maybe 3 to 4 times a year. So once you've got that 3 to 4 time opportunity per year, and you've identified your stocks that you want to follow, right? This is not something where you're going to look at 8,000 stocks every day. You should have, everyone who starts trading should have a primary list of stocks. Primary list. Amazon, Google, Netflix, Facebook, Microsoft, whatever it might be. You pick your primary list, and it's usually the most widely held, biggest stocks, right? So if you're going to trade the Qs, the NASDAQ, you're not really going to be trading the NASDAQ without considering the impact of trading Amazon, Google, Facebook, Netflix, etc. by themselves, because they are the Qs. They are such a big group of collectives.
That you were mentioning this yesterday, I think, about how before trading a individual stock, look at the index to see if the index might have actually a better stock.
So particularly at earnings season, right? So a lot of guys during this period between now and the next 3 weeks, a lot of the companies are going to be issuing their earnings statements. So if you're a risky trader and you're happy to hold through earnings, then by all means do a single stock trade, right? With the earnings coming up, trade it. trade it according to your plan, right? So you might want to trade it the 10 days before earnings, ride it up the Keltners, exit before the earnings announcement. That's a strategy that we do fairly often, but pick your tool right. So pick your vehicle, be it a butterfly or a long call or a call spread. Now, when it comes to, you like the sector, so you understand that sector is improving, it's got stronger momentum, there's a lot more relative strength behind it, it's moving up. You can choose to either trade stocks within that sector or just trade the ETF. So during earnings seasons, I always compare the ETF trade to the stock trade. And sometimes the ETF trade actually works out better. It's a little bit simpler. And I don't run the earnings risk, and I don't have the issue of, the CFO making an announcement at the earnings report that he's running off with his secretary and stealing the company's money. I mean, you want to avoid that kind of stuff, right? Trade the ETF. And we've been doing a lot of index trades on our side, looking at seasonality, because they become simpler trades. They're like easier to win, right? So if I know healthcare, for example, has been quite a big trading, a trending stock at the moment. We got into healthcare a couple of weeks ago. We've got, I think it's a double on our trade, and we stick in it. Now, under healthcare, you could go in and do a pilot position on Pfizer, for example, or you could look at one of the bigger components of the healthcare sector and start building an individual position in the strongest stock in the sector, post its earnings or something. You could look at biotech. You could do it with anything, but it's just remain consistent. The hardest part for people is remaining consistent.
So I had a question about the sector indexes. Obviously, you got the 11, S&P 500 sectors, and then you've got ETFs for everything out there. Imagine. Yeah. So what about the subsector ETFs? Let's say, healthcare, you've got, pharmaceuticals, you've got medical.
Let me share my screen and I can show you what we've got, right? So what I do each day is I look through different kinds of things. Now, this is pretty easy to find out. I took a couple of, big trends, and, there's the major sectors, there's the asset classes. What you do is you can just copy these out. So go through to stock charts, really, really cool tool on stock charts, right? So if I want to look at this relative, okay, so I'm going to compare this to the SPX. All right, so those are all my sectors. Okay, I'm usually going to click this onto the daily for 14 days. So what are the things that have been moving over the last 14 days? Well, biotech has had a huge run and it's now improving. And we can go into the graph and I'll show you what's happening there. IWC, which is the micro cap sector, has also started to move, and XLE, which is energy, mining and metals. We've got a position in mining and metals. We have a position in LABU, which is the triple leveraged biotech. We haven't got positions in these. We've got a position in XME. We have a position in XLB. We have a double in ITB. We closed our position in XLC, and I think we got a position in XLR. But let's just play this through, right? So XLV and XLU are two trades that we have as well. So XLV, if we go and have a look at XLV as a trade, so here's the healthcare sector, right? Trading up towards the top end of the Keltner. We can see a predicted price level up here around the 25th of May at around 125, which is not far from where we are now, right? So there's not a huge amount of upside left in this trade. So at this point, we'd be looking to get out of this trade and take profits. We could either be adding a short call onto it. We have no sell signals yet, all right? I have no sell signals on this trade. So with XLV, that's our position up at the moment, right? So we're up 37%. We've been in the position for, let's see, this has been going since the 30th of March, right? So we started building it when we got our first buy signal. And this is how you build the position, right? So as the trade starts improving, you start adding more to it. So if XLV becomes the trade that we want to play on, what we do, is we go to the individual subsections of XLV. And what we want to look at is what are the healthcare stocks sitting within XLV that are worth looking at as far as opportunities, because you could have the index trade, but now what we want to do is get another trade on the books, maybe with the stocks that are in this blue group. So what I do is I look at the blue group and I look at the red group. Those are my two focus areas. So there's the blue group, there's the red group. The reason I like those groups is because usually once things are lagging, they move up to improving. When things are weakening, they become lagging. This is where it's going to be the cheapest to get in, right? So cheapest to get in, hold it, go through to the green area. So I start building in blue. I continue to hold, sorry, I start in red. I continue to hold in blue, take profits in green, avoid the yellows, right? So that's literally how I do it. So from here, if I look at the stocks, the one that I like trading the most because of liquidity and size is Pfizer, right? BMY is also another one that you could look at. West is another one you could look at. PFE, West, BMY, EW. Those would probably be my favorites. ISRG is nice. It's just expensive and the spreads are hard on the option. So if we look at PFE and we decide, so the first thing we want to look at is there's the pullback, right? So there was a sell signal. There's the pullback that I'm looking for. It's a bit overextended above the third Keltner. I wait for the pullback. Now, am I going to get a better pullback than that? Probably not. And I've got earnings coming up. So I've got a catalyst event. I've got the pullback. Could we see this take out the 43 price point? So let's go and have a look at the options chain. So we go to PFE and we see the expected move. So from 38 to 43, we're looking at around $5 move, right? So the options market is already telling me that that $5 move is going to take place by December. So we shouldn't be expecting a huge breakout kind of move here. This is not going to be a highly volatile stock. And you can see that it doesn't have a squeeze, all right? So there's no compression forming. The momentum to the upside is already starting to decline. So this is not going to be a trade that you're going to be holding, for an explosive move to the upside. So for PFE, if you're going to do it, you'd want to be looking quite far out. So I'm looking at PFE as a trade on the whole back of COVID, right? So once we start seeing these COVID vaccines going out and Pfizer, Moderna, BioNTech, all of those guys are going to be seeing a lot more interest in their numbers based on the profitability that these vaccines are going to create. There might be some upside opportunity. By all means, I'm not a biotech analyst by any form. So, don't take this as, gospel, but that's the way I'm interpreting this. So I could add a very, very long dated 30 delta long call into Pfizer quite far out, just to see if this trade can start to work, right? It doesn't have a lot of resistance to the upside. All right. So the only form of resistance is going to be this previous high. So there's no cloud above it. It's got no resistance levels over here that it needs to get through. So I don't see much stopping it from getting there. I don't think it's going to get there now, but over the course of the next couple of months, it might start developing into a reasonable position. So with Pfizer, we start with a July trade. We just say, you know what, let's see what happens.
Just like a pilot position. Is that what you're
very much a pilot position. I'm putting it out there. If it doesn't work, it's only $250. It's not a huge amount of money. But as this trade starts to build and as Pfizer starts to move up in price and as we start hitting that support level, that 43, we may have an opportunity to add a little more, maybe build this position, throw in a little bit more on the capital side and build this trade out. So you can do this. It's quite a bit of work when you manually do it from this side, right? And you could look at it on REGN, you could look at it on Merck, you could look at it on, let's look at BMY. I haven't looked at BMY, but happy to do it now. You take BMY and you go, well, there's a pullback. Here's my price target, 67. It's not far away from where we are. Earnings are on the 28th. So earnings are tomorrow. So would I trade this into earnings? Nah, I'd probably just give it a miss. Wait for maybe Thursday and then see if there's a trade to be able to be done on BMY at that
So
point.
as a rule, you don't hold through earnings.
I try to not hold through earnings. There are some trades I'm more than comfortable holding through earnings because my original plan was to hold it for 2 to 3 years. So if I'm going to hold it for 2 to 3 years, I'm going to go through a number of earnings results, right? But I just make sure that the position is small and that I can handle any volatility that comes along. You see, the thing is, you want to try and avoid overloading stuff. And if I'm trading an index, for example, I don't mind overloading it because I don't run the same risks as holding that individual share. So with biotech as a sector, it's not the world's biggest sector, but I'm getting a lot of buying signals, right? So I've got an immediate switch here. I've got a buy signal. I've got quite a lot of resistance. It's got to break through this Ichimoku cloud. And then we have this profit target at the 121 extension up here around 182. Look at the price where we are now, 139. And we've got a high probability using the Elliott wave theory of us getting into that price box. So I'm pretty comfortable going in with a trade here. And look at the squeeze, exhaustion to the downside. We've got compression forming here. And now this could fire up and we've had increased volume. Look at the differences of volume over here. So bullish crossover here on the MACD indicator. We've got 2 buy signals here on the candles. We've got an 80% probability of hitting into the profit box. Sounds like a trade to me. Don't need to overthink this one. Put a pilot on. So I prefer trading LABU, which is the triple leveraged version of this. Similar technical pattern that we have here on LABU. Very, very similar. So if I've got that buy signal, doesn't have a green box yet. It's just got the gray box. So as long as I've got one buy signal, I've got the slingshot squeeze formation over here, bullish crossover. This to me is a trade. Small one, all right? So how are we playing this? Well, we're doing 2 butterflies on LABU. Both butterflies are now profitable. So we're up 30%. And what we can do is, it's not the most ideal. We've got one long call option sitting over here at 95. And if you look at the expected move of 83 plus the 25, we're looking at a move of 110. So one of the things that I like doing is putting in the expected move onto the trade itself, onto this theoretical calculator, and then seeing what the price of the stock is going to be if I got the expected move. So if I get the expected move, if the options market is correct, stock moves for this at expiry, the option that I've just paid 21 June, the 18th June 95, I paid $4.40 for this trade. This option is going to be worth $13.49.
Nice.
So that's a 200%. Okay, so I'm comfortable with that. That would be fine. And as this trade starts to develop, so each day I go in, I look at the trade. Does it have another green buy signal? Is it getting closer to the third Keltner? When it gets to the third Keltner, I might take off 1 or 2 of my contracts so that I can actually start taking some profits out. I might take those profits and recycle them into the same stock, but now I'm using profits and not capital. So it becomes a more efficient trade.
Now, seasonally, is biotech, does it do well in the summer? Chris? They've got a little lag here, folks. See if we can get Chris back on. Okay. All right. Well, some minor technical difficulties, but we're kind of coming to the end of the show. Bell's about to ring, so we're going to say goodbye to Chris, and you guys have a good one trading. Talk to you next week.